If it dropped to zero, which it won't, you will only lose 415, and you do not have to realize this loss, because if it drops that way, you just keep you keep rolling the options to another 7 days, then another 7 days, until the market comes back. In the S&P 500, as you guys heard me say a lot recently, it always, with no exceptions to this point, always comes back. So what I want you to understand is that this futures contract is the shares. It's not shares, but it acts almost exactly like shares, except it does expire. The futures contract expires every quarter, but it does not have time decay like a option does. It does not lose value as time passes. It's going to keep its value just like shares would, even though it's not moving up or down. It's going to keep its value. Futures contracts have what is called mark to market, and that just means it settles your tab each day. And this morning I was using the example of you going to the bar, you open up a tab, you get as many drinks and food or whatever else you can buy, and then when it's time to leave, you settle the tab, you close the tab. Well, that's what's happening with futures contracts every single day, and they call it mark to market. So whatever you win that day, it gets credited to your account. Whatever you lose that day, it gets credited to your account. And so if you went over a 30-day period and you added all the days you won and all the days you lost, if that's a positive, then you made money. If that's a negative, then you lost money on the futures contract itself. Not talking about the options yet. The futures contract acts as the shares. Think of the futures contract as the shares, and that will make it clearer for you. If you had 100 shares and you're considering the MES as shares, each share equals 1 delta, as I was indicating this morning. So if you start this off by buying the future, just think of it as 100 shares. That equals 100 deltas. Okay? That equals 100 deltas. I know that poor writing, but bear with me here. Now, if we sell an option on the call side at a 25 delta, then if you sell an option that's bearish, if you sell a call option, I should say, on the call side, if you sell a call option, that's bearish. So whatever delta you sell it at, that's going to be your bearish delta. So if I sell a call at the 25 delta, then that's going to give me negative 25 deltas. If I buy a put, buying a put is also bearish. If I buy a put at the 25 delta, that's going to give me another negative 25 deltas. So if we add it all up, right, we got a positive 100 minus 25 minus 25, we're going to have a positive 50 deltas for this collar strategy. The collar trade is bullish. Even though you do not have risks all the way to zero because of that put that you buy, it's a bullish strategy. Even though you're selling that call and that's bearish, you're buying that put and that's bearish, it's still overall bullish. You want it to go up. You're not rooting for it to go down because the deltas dictate your directional risk. So if you buy shares outright by themselves, you know your risk is to the downside. This is like buying shares outright, but not 100 shares. This is like initially buying 50 shares because it's positive 50 deltas. So that means you still want it to go up. Just want to take a quick second and say if you're interested in learning more, please consider joining our trading club. You can do so for a 90-day trial period for a flat $60. Check out the description below. Now back to the video. Now, when you set up the trade, you need to set it up with this in mind, understanding that it's bullish, but you want to have your assumption when you initiate in the trade. What is that assumption? Over the next 7 days is the MES, which is the S&P 500. It's just the micro E-minis. It's small. It's half the size of the SPY ETF. What is your assumption? Is it going up, or is it going down, or is it going to be flat over the next 7 days? So now that I know that the collar is a bullish strategy, I'm going to set this up the best way I can. So I'm going to look at it first. And on TastyTrade, you can hit this go and you can start with a covered call, or you can just buy the future outright right there first to start with the future, and then you set up the call. So let's just say I am somewhat leaning bullish over the next 7 days. I'm just using it as an example, but I don't want to be too bullish. So let's just say I sell this 64.05. That call is giving me $139. So what I want to do is buy a put for less than that. So I'm just basing it on this number here. It's jumping around, as you guys can see, but it's a 27. So I'm going to buy something for less than 27. So let's just say I decide to buy this 25 here. Well, it's going to give me an overall credit on the options part, right? It's giving me an overall credit for the options. It's not a great credit, but it's giving me a credit nevertheless. If you want to get at least a decent credit, and to me, a decent credit is $50, you would subtract 10 from this number here. So that's a 27. If you subtract 10, that's going to be 17. So I'm going to buy something at the 17. So if I did that, that'll be here. And you can see I'm getting $50 here, $51. Now, because you want to understand the risk on a collar, if you're using TastyTrade, it's going to tell you what your risk is once you set up the collar. It's going to tell you your max loss. It's going to tell you your max profit. It's going to tell you your extrinsic that you're receiving. And it's going to tell you your probability of success. It's going to tell you your deltas. It's going to tell you those things. And obviously your buying power. But when you're doing it on TastyTrade for the futures contract, the ES or the MES or any other futures contract, it's only going to show you the buying power, your delta, and your extrinsic, the premium you're receiving off the shares, off the options you're selling. Everything else you're going to have to do the math yourself. On Thinkorswim, it shows even less before clicking on something. So you got to do the math yourself. It's still the same thing for the most part, but you're going to have to do the math yourself. So in this example, I can start off by determining how much am I going to make to the upside if I was initiating this trade. I know I stopped winning at the 64.05. So I can take that 64.05 and subtract 63.77 from it. So 64.05 minus 63.77 equals 28. So I have 28 points to the upside. Okay? And so that would equal, and it would equal 28 times 5 would equal 140. So I can make 140 plus the extrinsic, let's say $50. So I can make $190 to the upside. Okay, plus that premium. 190 to the upside because the MES is $5 per point. So you have to take that 28 and times it by 5. That's where I got the 140, and then I added the premium that we're receiving for those options part. That was $50. So 140 plus 50 is 190. Okay. Now we have to figure out the put side. So the put we have is at the 62.85. So you subtract that from where it's currently trading at. So you take the 63.78 minus the 62.85. That's going to equal 93. So it's 93 points to the downside. And if you times that by 5, so 93 times 5 is 465 minus the 50 of credit that you received. And so the most you're going to lose is the 415 over the next 7 days. If it drops all the way down to the 62.85. So you cannot lose more than 415 over the next 7 days. If it dropped to 0, which it won't, you will only lose 415, and you do not have to realize this loss, because if it drops that way, you just keep you keep rolling the options to another 7 days, then another 7 days, until the market comes back. In the S&P 500, as you guys heard me say a lot recently, it always, with no exceptions to this point, always comes back. So I know if I'm putting on this trade with these strikes that it's a bullish trade, or overall 39 positive deltas, that if it goes up and it goes up past the 64.05, I'm going to make at least $190 if I go to expiration, which you guys know we're not, but if we did, we'll make $190. If we let it drop all the way down past the put and it expired in the money and we did not do anything, we would lose no more than $415. That is the math to do this trade.